Hi guys, we are going to give you a quick preview of the concepts of various businesses and their costs of production. It will be a brief preview which can be elaborated later. So I wanted you to pay attention to the two different kinds of costs. One is called explicit cost, which is documented by receipt, which involves actual monetary transaction and which generates a receipt and documentation of transaction. So when you go and buy a burger, you get a receipt. That's an explicit transaction. Or when a business, a donut company buys some dough and has a receipt, so buying dough is an explicit cost for a donut company. And the implicit cost refers to the value which can be implicitly calculated, which is not necessarily a monetary transaction, but it can be calculated implicitly. Example, if that donut shop owner is operating the store inherited from grandma, then that donut shop owner doesn't really have a rental payment because that store is owned by the store owner, which was a bequest from the grandma. But you can still calculate an implicit cost of using that store for your business. Even though you own it, you can find out how much you would have earned as a rent if you would have rent that store to someone else, and you are missing out on that rental income because you are using that store that you own to run your donut shop. So in that case, that imputed value of that rent of that store would be your implicit cost. And I wanted to mention that accounting profit is the difference between revenue, total revenue, and explicit cost. So if a donut store has a total sales for a year of $100,000 and its explicit cost, all those receipts and all the wage and labor payment, all the utility bills, all the rent payment, all the interest payment, all the explicit cost, that totals to, let's say, $80,000. So then the accounting profit would be $20,000, right? $100,000 revenue minus $80,000 explicit cost. And in order to calculate economic profit, we have to do one more step. We have to use the accounting profit data that we have, like $20,000 in this example. We have to now subtract any implicit cost that business is incurring. For example, if we imagine that store is actually owned by that donut shop owner, which the person inherited from grandma, so there is no rental payment going on, but we have calculated that, that store rent could have been $1,000 a month. So then $12,000 over a year, that could have been the rental income that the guy could have earned, but now it's missing out on because they're using the store for the business. So now the economic profit will be $80,000 accounting profit minus $12,000 implicit cost. So now the economic profit will be $8,000. So again, the accounting profit formula is revenue minus explicit cost, cost that has a receipt, a transaction documentation. And the formula for economic profit calculation is accounting profit minus implicit costs. Okay. And in this graph, we clearly see it, where on the accounting profit calculation, we do we have this total revenue and minus accounting cost. That gives us this greenish blue shaded box called accounting profit. But in order to get the yellow box economic profit, we need to not only subtract explicit cost, we also need to subtract implicit cost, and then we get to this economic profit box. So here we see that generally, due to the fact that economic profit cares about implicit and explicit both kinds of cost. Therefore, economic profit is smaller in size than accounting profit. In our previous example, as you remember, the accounting profit was $20,000, 100,000 total revenue minus 80,000 accounting cost or explicit cost. But for the economic profit, it was only $8,000 because we computed it as follows: $100,000 revenue minus $80,000 explicit cost minus $12,000 implicit cost because of this missing out of rental income. That gives us only $8,000 economic profit. And just to let you know that the business owners operate their businesses with some kind of time dimension. A business can be operated on the short run, or a business can be operated over a long run period, right? So what is the distinction between a short run production activity and a long run production activity? In the short run, some of the variable inputs, it means the inputs that varies in quantity, they, in addition to them, there will be some fixed costs. So in the short run, there will be some kind of cost fixed. For example, if somebody is producing cherry tomato in their backyard, and that's their business, family business. So you notice that in that cherry tomato production in your backyard, there will be some variable costs, variable inputs like seeds, fertilizer, water, agricultural hand to help to weed out and dig the ground, till the ground, right? So those kind of things you can vary, but in this case, in one ingredient is fixed, like your land size, your backyard size. So as long as you are operating your tomato production and sale business from your backyard, we know it's a short run activity because your backyard size, your plant size, your land size is fixed. But in the long run, if somebody's tomato business grow exponentially, at that point, you may be buying a neighbor's backyard as well, or you'll be renting some few more acres to run your business, profitable business. So at that point, you are changing all the inputs, not only your seeds and fertilizers and number of workers, you are also changing the land. So remember, there are 4 basic factors of production: land, labor, capital, entrepreneurship. In the short run, at least one of those 4 elements will be fixed. But in the long run, all those inputs, all those ingredients of production are subject to change. And in the long run, farms are allowed to enter and exit, right? So with that note, I would suggest that we keep working on this chapter, and the more will be analyzed and discussed with you soon.